What we saw in the second quarter was that the bond market really ignored all of that positive economic data, and instead we saw interest rates decline for the quarter. Now, to put that in perspective, in the first quarter, we saw the broad bond market post its third worst quarterly decline on record. So it could be just some reprieve for bond investors during the quarter. What we think, though, is that yields at these levels are unsustainable. They don't justify what we envision to see for economic growth in the future, and also what we envision to see with slightly higher inflation than we've been accustomed to over the past decade. We don't think you should completely disregard fixed income. It still does serve as a diversification tool and also a hedge if economic growth takes an unexpected turn lower. But instead, we would make sure that you're positioned in short-term maturity bonds. These should help to mitigate interest rate risk. We would also look at some of the floating rate bonds. These are bonds with short maturities, but then reset as interest rates rise. And lastly, we would not reach for yield in this environment. The high yield debt market does look appealing because it offers probably one of the higher yields in the fixed income market, but at the same time, its yields at a record low. So we don't think some of the credit areas are really rewarding clients for the risk that you're taking.